Listen, thank you everyone for attending tonight, and apologies for being late in starting. But today, I would like to firstly say Happy New Year to all of you, and I hope you all have a extremely successful year in whatever you are planning to do. And hopefully within that plans, there is a property investment or a first home purchase or a second home purchase or whatever you're doing with your on the property side. Today, I would like to actually give you some real insights into what the Sydney property market is going to do. This session today in conjunction with the Avenue Real Estate in Castle Hill. Don't know if Soha will have time to join us today, but we work closely with Soha, and a number of you are his invites today. But my background very quickly, as you can see there, won't go through all of it, but I've spent a good part of 30 plus years in banking, having senior roles across a number of banks, at least three major banks in Sydney. And during that time, I've had a lot of exposure to the property market, to global markets, to financial markets, and in particular have had a lot of dealings and have been the key liaison everywhere I've worked with organizations like APRA and the RBA. So hopefully what I can do today is give you my insights, my predictions on where I think the property market is going. And without further ado, we will start off by the pricing heat map. You all know we are beginning of the year now in 2022. You all know what happened last year, well documented. So the full year, Sydney went up 25.2%. Brisbane was the winner for last year, if we can say that, 27.4%. And Adelaide not too far behind, actually, 23.2%. So these are big numbers. These are very big numbers. The past 3 months is very interesting. We are slowing down. So past 3 months in Sydney has been 2.7 compared to Brisbane, Gold Coast at 8.5 and Adelaide at 7.2. So there's momentum happening. In the last month, Melbourne was actually minus in the last month. So real shift there happening over the last few months. Sydney is only 0.3% in the last month. And the Brisbane Gold Coast still got a lot of momentum at 2.9 and Adelaide 2.6. So very interesting figures. I didn't mention Canberra, which also has been quite strong last year. Now, just to inform all of you, when you look at these numbers and you hear the news, the thing is that what you're actually looking at in the number is a median of all types of properties across all of, whether it is Australia or whether it is a particular region. It is every single type of property. That is a very important thing to note, okay? And so Australia's growth was 22.1 for the year. Now, only 2 other years, this is very interesting, only 2 other years in the past 100 years have experienced this type of growth. In 1989, we had 29% growth. And in 1950, we had 111% growth. So there's only been 3 years in the last 100 years which have had this type of growth. Okay, I won't go through, I don't have time today to explain why it was 111% in 1950, but 1989, certainly I was around, and it was a very interesting year, year where there's a lot of recovery starting in the property market. But I do want to stress, and what I'll talk about today is actually differentiating between markets. So Sydney, if you look at Sydney, 25.2, within this 25.2 is every type of dwelling. And Sydney is not a one suburb market or a one city market. Sydney is, probably you've got 20 to 25 markets across the whole city. Okay. And they all behave slightly differently. And that is the key point that I'll, for you to take away today. Now, and this demonstrates it quite well. So if we look at houses versus apartments and go straight to Sydney here, what we're looking at is that house prices have gone up significantly. So if you were to just look at the house prices and not discount the apartment prices, by far Sydney is the winner. Okay, Sydney has had over 30% growth in houses, brought down to where it is because of the apartments. So the blue here is the apartments. Okay, so when you look at it, apartments have not even gone halfway to the house price growth. And I think most of you would also know that, right? There are some suburbs in Sydney where you could say that apartment prices have only moved about 2 to 5%. There are some suburbs in Sydney where, of course, it has gone up 20, 25%. But generally speaking, overall, that figure has been a lot lower. And this is the one of the big points I'm going to make today. Now, before we jump into some predictions and what I think, one of the key things you got to look at is what are price movement considerations, okay? And this is in some sort of order. So first and foremost, Economics 101 taught us that supply versus demand is what causes big movements in prices. Supply, we know, has been low, and demand, we know, has been significant, okay? The demand has been coming from a number of different areas throughout 2021. And it is at the high end of the market, the demand has been significant. So when I talk about the high end of the market, I'm talking about the prestige high end of the market. You're talking about the $5 million to $25 million price range. And if you Google and see who was the city, which city was the leader in the world in that prestige space, it was Sydney. Okay, I'm not saying it. Google and find out. Sydney outstripped the rest of the major cities in the world, whether it was New York, London, you name it. We were at the top end. So at that point, there are stories of prices going up even 70, 80, 90, 100%. Okay, where they thought they might get 8 million for a property, it might have gone for 15 and so on. That has happened, but demand has also been very, very, very strong right across all the price points in our market. And that's been fueled very much by the very strong affordability. Affordability became strong because interest rates went down. That was the biggest thing. I never thought that in my lifetime I will see interest rates below 2%. I have bought properties in the early 80s, and I have paid 17.5% interest rate. And I can tell you that I never thought for the life of me that I'll see interest rates below 2%. But you have got still today interest rates for owner-occupied rates around that 2%, some fixed rates around that even sub 2%. So affordability has been a big factor driving this. Of course, if you're borrowing at 3% versus 2%, you do the sums, you can borrow a hell of a lot more money. Now, the other aspect of it is, and there's a lot of talk about where is interest rates going to go from here, because it is a very significant determinant of where property prices movements are going to go for this year and next year. Now, the key thing that drives interest rates is inflation. The key thing that drives inflation is wages growth. Okay, if wages grows, of course, inflation, which is commonly called the CPI, okay, is determined by a number of different factors. And the Reserve Bank wants the inflation rate to be in that order of 2 to 3% is where they like to see inflation. Now, inflation has been much lower than 2% for quite a while now. And suddenly it has ticked over into 2.1 in the last numbers that we saw. And it's gone into the 2 to 3% range. As soon as it went over 2, all the economists out there and scaremongers all said, oh God, interest rates are going to go up now. We're within the target range. Well, not so fast, because it's just gotten there, and it's got there not mostly not because of wages growth, but there are other factors like I said in CPI, things like your petrol prices, the oil price has gone up, so petrol prices have gone up. Your fruit and vegetable prices have gone up. Your rentals have gone up. These are all determinants of the CPI and therefore the inflation. And that's what we've got to keep an eye on. Okay, we've got to keep an eye on wages growth. In my view, wages growth in particular, and secondly, the things like rental, which has a lot to do with cost of living. So rentals we will talk about later, and that's why this is a real headwind. Okay, that we will talk about. APRA have eased policy for most of 2020 and 2021, except you will all know, and it's well documented, that in the last quarter of last year, APRA did some tightening again with the lending policy, with the bank lending policy. And what it means is that where APRA look at you when you borrow money is not where you are borrowing, but they actually add a buffer. The banks actually add a buffer to the borrowing rate. It's the variable rate we're talking about here. So if your variable rate is 2.5% that you're borrowing at from the bank, the buffer that they normally add is normally another 2.5%. That has been increased to 3%. So when the bank assesses you at 2.5%, if your rate today is 2.5%, they will actually add another 3%. So they will see if you can still afford that loan at 5.5%, 3 plus 2.5. Okay, hopefully that makes sense to everybody. So at 5.5, if you can still afford the loan, that's where they're going to be looking. Okay, the maximum lending that they will give you will be based on that rate. Now, if you're borrowing at 2.6, of course, it will be slightly more. If you're borrowing, depends what your bank is lending you at. So that will have some impact to take the heat of the market. We have had so much heat in the Sydney property market, as you all know. And as I said, not in the apartment space as much, mostly in the existing houses, new house and land, new land. That space has been extremely, extremely heated. It's not healthy for the market to be so heated. So that heat needs to come off. The only way it's going to come off is for APRA to use one of the levers to stop it, or actually to slow it down. Okay, we can't have a heated market forever. So APRA have used one of the levers. There are lots of other levers they can use. In the next 3 to 4 months, if we see some of that heat coming off the market, and we're already seeing that, you saw the price growth is slowed down. All right. So if some of that heat starts coming off, they might not do anything else. If it doesn't come off, say in 3 months' time, they will use other levers for sure. Okay, to take the heat of the market. And when I say heat of the market, it is very much in that high end of the market where there's been significant heat. Your North Shore suburbs, your Northern Beaches suburbs, your eastern suburbs of Sydney, where prices have just gone crazy. A house that was 3.5 is now 5. So that's heat in the market. This is more than your 25%. Okay. Next point is very important as well, and I'll very quickly talk about it. And the reason why most of the so-called economists or pundits actually said in 2020 that the prices in 2021 will fall anywhere between 20% to 30%. Okay, all of the known economists, bank CEOs, and everybody who is so-called in the know said that property prices will fall a lot because GDP was going to fall and become negative for a prolonged period. It did not. Okay, unemployment was going to hit as high as 12%. It did not. It stayed sub 8. Unemployment is now back at around 4.6. In my view, it will come down even more, and you'll hover around that sort of mid 4s to high 4s. Okay, throughout this year. As far as GDP is concerned, we saw a negative growth in the last quarter, the September quarter, I should say, not the last quarter. The September quarter figures came out, and we had a negative GDP growth of so the economy contracted in the quarter by 1.9%. The market had it contracting at 2.7%. So it contracted less than what the market thought that quarter because half of Australia was shut down in that quarter, including Sydney and Melbourne. So you did expect GDP to actually take a bit of a hit. But what will happen? Some of you who have heard me before in August, in September, and October, and November, I very clearly said that as soon as the lockdown is over, we are going to see GDP shoot through the roof. Okay, you could see a December quarter GDP that could have an increase of over 3%. So it more than offset the September quarter decline. And yesterday, the November sales figures came out. And if any of you saw the news, the sales figures for November has broken records. We spent $33 billion in the month of November. Australians spent $33 billion in retail sales. It is a record, okay? It is up 7% month on month. So that is a trigger for GDP. So GDP means people spending money. And I've been saying it for the last probably 6 or 7 seminars that I have done. If you can't find parking in the shopping centers, you know that GDP is going to go up. People are spending money. They're cashed up. Okay. So these two, we need GDP and unemployment to be strong to see price movement. Okay. My prediction for this year is despite the Omicron and despite all of the negative press you are going to see as a result, these two figures are going to stay very strong in Australia and in Sydney, New South Wales. Both these figures are going to remain very, very strong throughout this year. Okay. And there's good reasons for that. You will see that in the next following slides. Government spending, infrastructure, and incentives. I won't go through all of that. You all know that. You all know about JobKeeper, JobSeeker. You all know about how much money the government is spending on infrastructure, in bringing forward infrastructure. And that is all to ensure these two numbers stay well. Okay, keep healthy, unemployment and GDP. That is very, very, very important. And it's not as important to worry about how many people are unemployed in Europe or what is happening in the US. There is some importance, and that's my last factor here, is global factors. Okay, it's not at the top of the list, it's in the last factor. They do have an impact, but if there is a recession happening in some of the Northern Hemisphere countries, and we can still have significant GDP growth, and we have shown that. So in COVID last year, the economy in the UK actually contracted 20.5% in one quarter. Okay, in one quarter, 20.5. Like I said, September was minus 1.9. 20% it contracted. Did it impact our economy? It did not. So that's just an example of that. Now, the sixth point here is also important. For prices to go down 20 to 30%, where people were talking about it in 2020, mid-2020, you need to have significant delinquencies and write-offs in loans. I'll try to explain that to people who don't understand this. So delinquencies, banks call a housing loan a delinquency. When you have actually when somebody hasn't paid their housing loan for 3 months in a row, okay, that's a delinquent loan. After that, the bank will start taking action to put your house on the market and have what they call a mortgagee in possession sale. Well, I can tell you, I have sat on the risk committees of banks for many, many, many years. And the amount of time we spend talking about delinquencies and loan write-offs, mortgage write-offs, okay, housing loan write-offs, in a 4-hour meeting, you'd probably discuss it for 5 minutes. It is not an issue, has not been an issue for banks for the last 15, 20 years. I can tell you that, okay? In Australia, people pay their mortgages. Simple as that. They pay their mortgages. They might not pay their housing loans or their car loans. They might not pay their personal loans. They might not pay their credit cards. They will pay their housing loans. So it's not something that banks really worry about. Okay. I don't know when last time any of you saw a mortgagee in possession sale. So that's an important point to note. And banks, 50% of a bank's asset is the big 4 banks in Australia. 50% of the assets are actually mortgages for residential, okay, residential mortgages. So it makes up, that's their bread and makes up half of the balance sheet. Okay. I won't dwell on global factors in the interest of time, but these factors can have sort of knock-on effects to our property market. Are they that important? Probably not that important. That's why they're number 7. But these are my top 7 of issues that you need to be aware of when you're looking at what will move the needle when it comes to how property market and the house prices. Okay, this is probably the most important slide for tonight. And I want all of you to really understand the underlying figures. And these are not my figures, by the way. These are the figures of the New South Wales Treasury, okay, our New South Wales government. So by 2054, so this is all obviously long-term planning. By 2054, we'll have 8 million people living in Sydney, just in Sydney, okay? And we will have 6 million people by 2036. That is a massive increase. Let me tell you, you look at all the Western cities in the world, and you look at percentage increases in population, these figures are massive. And the reason why we are spending so much money in infrastructure right now, so you look at the figures on the right here, 50 billion of new transport projects over the next 10 years, okay? This is transformational change. So what you are witnessing in this city right now is once in a 50-year transformation, whether it is the new roads being built, whether it is the tunnels that are being dug to put metros in, to put roads in, whether it is the new airport that is being developed, it just goes on and on. You see so much that is happening, so much has already happened, and so much more is about to happen in the next 10 years. This is a massive amount of spend, okay? And that's just the transport projects. Then you've got the amount of money we are spending on hospitals, on schools, on universities, and the like. So all of that is either being expanded, or new hospitals are being built, new schools are being built all over Sydney. It doesn't happen by chance. It is all happening by design to cater for this population growth. This is a massive population growth. For this type of population growth, you will need almost 40,000 new dwellings per year. 40,000 new dwellings per year, okay? So if some of you are thinking, well, there's a bit of oversupply in apartments in Parramatta at the moment, and maybe a bit of oversupply in Zetland and a bit of oversupply in Kellyville. Is there? Absolutely there is. Will it get absorbed? Very, very quickly. We have had nearly 18 months, well, in March, probably 2 years of almost negligible migration, and no students coming here, and a lot of students going back as well. So that has halted, I suppose, some of the vacancies. And so we need to fill those vacancies, and they're going to fill. So we will talk more about that in a minute. But it is very important for everyone to really understand these numbers, because these numbers are extremely important. Now, if I add not just the transport projects, but if I add all of the infrastructure that is happening in our city over the next 5 years, whether it is hospitals, schools, roads, airports, et cetera, Atropolis, I haven't mentioned, all of these projects, right, is more than the rest of Australia's projects added together. I'll say that one more time. If you look at all the infrastructure projects, every single type of infrastructure project that we have in the next 5 years in our city, it is more than the rest of Australia added together, which means that is going to keep our GDP growing substantially. That is going to keep our unemployment low. I think our unemployment in New South Wales has the potential to go down to 4%, okay? And that will drag the rest of Australia's unemployment figure down. So already there is shortage of staff. Already there is significant investment happening. So please keep that on the back of your mind, because this is extremely important numbers. Now let's talk a little bit about the forecast. I thought I'd throw this in first. This is ANZ's housing price forecast. So keep in mind, keep on the back of your mind that in 2020 June, ANZ was predicting 2021 to be minus 25%. CBA in the same time in June 2020 was predicting also predicting between 20 and 25% fall in 2021. Well, you just saw the numbers. It went up 25%. Okay. So for what it's worth, I thought I'd just give you an example. ANZ, so Sydney is here. So Sydney, this is 2022. Okay. This is 2022. They're predicting about a 6% increase in property prices. Now, again, we're talking about right across the pitch, every single type of property, every single suburb. Could this be accurate? It could well be accurate, okay? In 2023, though, they've gone negative, right? They've gone minus 4%. All these cities, they are looking at 2023 minus. Okay, they may have some good reasons why they're predicting that, okay? I will dismiss these numbers straight away because I think we will see growth again in 2023. 2022, overall, it is quite likely that the figure would be somewhere between 5 and 10% growth. But as I will talk more through the other slides, I think apartment prices are going to far outstrip the house price growth in the next 12 months. And that's where I'll take you now. So the next 6 to 24 months, I call it the perfect storm for the apartment market, okay? And this is, I'm talking about Sydney, I'm not talking about any other part of Australia on this. Why? These are the key factors why. We've had historical low interest rates and high appetite for banks to lend. This is true for all over Australia. But this is where demand is going to pent up, okay? So demand, migration has not had a huge impact on our house prices, but it is going to have a huge impact on the apartment prices. Retaining expatriates and students, particularly students and migration, is going to have a very positive impact on the apartment prices, okay? Investors are going to come back into the market, and investors, 80% of investors actually buy apartments. They do not buy houses or house and land, probably because it's not as affordable. But investors are going to come back into the market very, very strongly. And the thing that drives investors more than anything else is the return. The return is going to go up. If interest rates stay low, the rentals are going to go through the roof. Okay, we'll talk a little bit more about rentals shortly. In some places, it's becoming cheaper to buy than rent. And this one is important, the Foreign Investment Review Board approvals, which is bringing the demand factor up. These are non-residents. If you want to buy a property in Australia, you need to get a Foreign Investment Review Board approval. The FIRB approvals, since COVID started, actually has been shooting up. The graph has been shooting up. You will not believe where some of this demand from non-residents is coming to purchase a property here. It's coming from Canada, it's coming from North America. Of course, Asia has always been big. It's coming from UK, it's coming from Europe. So all over the place, people are looking to purchase a property here, okay? So all of these factors are your demand factors. Demand is gonna remain strong, but actually go through the roof in 2022, particularly for apartments. So supply will continue to become lower than demand. Listen, it takes you, to develop an apartment project takes you at least 3 years, at least 3 years. It takes a whole year to actually get a DA approval, a development approval from the council, okay? And then it takes at least 2 years to develop it. So 3 excessive apartments and vacancies in certain places right now, it's going to be absorbed in no time, okay? I've already talked about the New South Wales government having a very strong balance sheet, low unemployment, huge infrastructure spend. That is going to fuel growth in our city for the next 5 years. You don't have to go looking at other cities to invest in. This is the place where it's all happening, okay? Next point, also extremely important, the consumer confidence and business confidence really took a dive because of COVID. So in 2020, between May and December, of course, the consumer confidence was extremely low. It was at record lows for the last 25 years. And the reason for that is people were worried about whether they've got money to put food on the table, whether they will have food on the table, whether they will lose their jobs, indeed, whether they will lose their lives. So their consumer confidence will go down in those type of situations. Business confidence was, of course, extremely low. Small businesses were locked up. They were almost going broke. So those two factors were down. Where is it now? It is right up there where it started before. Okay, it is right up there. Consumer confidence. People did not lose their jobs. Most of you listening today probably know very few people who are in high-paid jobs that actually lost their jobs. Okay, your vacancy levels today, your job ads today are going up and up and up. Your salaries are now starting to actually tick up. That's why I said look at wages, because that'll have an influence on the inflation number and the interest rate. So these things are back up and quite strong now. Okay, and I suspect that it will stay strong. Our economy needs that. Our infrastructure spend needs that. Our unemployment is already very low. In this market, if you can't find a job, it's not the job. I mean, with all due respects to all of you, it is there's probably you're probably not looking hard enough. Okay, it's a market where there is ample number of jobs. Economy is really strong. So why should you buy an apartment now? Why am I talking about apartments, and why should you buy an apartment now? Okay. This is the reason. There is a huge gap that has developed between house prices and unit prices. Okay. This gap will start to close from, sorry, I haven't changed the slide. Okay. This is for 2021 up to mid this year. Okay. So this 6 months starting from now, okay, started already in November, December, but going into this year up to June, this gap is going to start to close. We are already seeing the start of that in November. So all of the apartment developers, and we talk to all of them, whether it is the big ones like Meriton to the medium-sized ones to the small ones, they stopped giving incentives. They stopped giving discounts. Okay, no cashbacks. All of those things started going away. In fact, they started to increase the price. Meriton have in the last 6 months had at least 3 rounds of price increases across all of their projects in Sydney. That is the start. The big guys do it first and then it filters through. So you will start seeing this demand that I talked about, okay, will be a big factor. And there's another big factor is a large percentage of our population now will find it more difficult to afford homes in Sydney, okay? So the latest numbers just came out, right? There are another so many suburbs that have joined what they call the $1 Million Club. Box Hill, Toongabbie, Constitution Hill, Marsden Park, South Wentworthville, to name a few. They have all joined the median $1 million club, which means to buy a house there, you need at least $1 million and more, okay? And in some cases, a lot more. So that affordability that was afforded to people because of the low interest rates, and they have not lost their jobs, and the husband and wife are working, they suddenly could, instead of borrowing 700, they could borrow $1 million, 1.2 million. They got into the houses. Now the house values have gone up significantly. To give you an example, we were selling land on Tallawong Road in Rouse Hill. Some of you may know Tallawong Road in Rouse Hill. We were selling a 300 square meter land there last year. Sorry, not last year. I keep saying last year. I know in 2022. We were selling 300 square meter blocks of land there in August 2020. Okay, just over a year ago. For $550,000. The same land now, sort of 16 months later, is $900,000. I'm not exaggerating. They're $3,000 a square meter. Okay, So that's not a 25% increase. Do your sums, that is more like a 75 to 80% increase. Okay, it has gone up significantly from 550 to 900 in a 16-month period. Some of you who bought land at the time or bought house and land at the time, you know what I'm talking about. You're sitting on a massive profit already. Okay, so this is a very important factor. So more people are going to have that fear of missing out, and they're going to say, well, I need to buy a property. What am I going to buy? I can't afford a home anymore. Let me buy an apartment, because that is what it's coming down to. That is going to fuel the apartment prices. Okay, and demand of units will outstrip supply. If so, forget about the fact that there is some pockets of Sydney, 5 or 6 suburbs where there is a bit of an oversupply. Forget about that. That'll get absorbed in this first quarter. Our borders are open now. People are coming in plane loads. Okay, that'll ramp up through this year. That'll ramp up in big time. So what I'm suggesting to all my listeners today is you have an opportunity to take advantage of what we call price arbitrage. You gear to have advantage of price arbitrage. What I mean by that is you buy an apartment now with 10% down. Say you buy an apartment for 700,000 or 600,000. You put 60,000 or 70,000 deposit, and that apartment will not settle for a good 18 months, 12 to 18 months at least. In some cases, we have projects where it might not settle for 2 years. In that 2 years, if the price goes up by 20% in that 2 years, okay, which is highly, highly likely, you will make 20% on the full price, on the 600 or 700,000. Okay, 20% on 700,000 is 140,000. So you pay 70,000 now, and in 2 years' time, when they come to settle, somebody tells you, well, listen, your valuation is coming 140,000 more than what you paid for it. That is a price arbitrage. This is how you make money in property, okay? This is how you make money in property. So this is very important to take advantage of this price arbitrage before this gap actually closes. House prices went up that much, apartment only that much. That gap is going to close. Believe me, I have been here for 40 years in this city and investing, and I have not seen this type of gap develop. And the only reason why it has developed is because we have not had migration and we have not had students, tens of thousands of students. Okay, they're coming back. They're coming back in numbers, in big numbers. Okay, we are going to see anywhere between 100 and 200,000 people come to our city this year. Don't believe the numbers that the news tells you. Okay, people are holding on to their visas for the last year and a half. They haven't come here because they had to come in quarantine. They don't have to do that anymore. Okay, so a normal migration in our city is 95,000 people. This year, if we have 150,000, it could go to 200,000. If we have those numbers, people will have to sleep on the streets. It is that simple, okay? Please understand that. I can't make that point any more stronger. Now people are starting to talk about the apartments. Financial review, 8th of September. Apartment price is set to bounce as house prices become expensive. 8th of August, Domain, Sydney apartment prices getting momentum as affordability bites. Business Insider, prices are beginning to turn around. We are at the start of the recovery in the property clock. This is for apartments, okay? Start of the recovery for apartments. It is going to peak sometime in the next 12 to 18 months. It will be listen, it's not going to happen overnight. It's going to be a slow process. But in the next 12 to 18 months, you can write it down now, and I can't be any more passionate about this point, is that you're going to see a 15 to 20% increase during that period when we reach the peak from where we are now. In some suburbs, I could see this in suburbs like Blacktown. In December 2014, I could see that apartments there were 270,000 for a brand new apartment. A brand new apartment in Blacktown now is 550,000. That's where they start from for a 2-bedroom brand new apartment, or off the plan apartment, as we say. Okay, it's almost double. It's doubled in that period. So listen, this is the start. This is the start. This is an opportunity. I'm saying this gap is going to close, and I'm urging all of you to think about it and take that opportunity by this arbitrage opportunity that I'm talking about. I'm going to show you a couple of 1-minute videos now. So I'll hand over to my colleague Nakul to actually start that. And The first one is interesting because it is the founder of SQM, and I do listen and read about what he has to say because he's very good in research.
You did say earlier on,
thank you,
you're going to make a slight reference to the unit market, you know. Can I ask you, units as a category of property?
Yes, so as we be all well aware, I'm sure your audience is well aware, in Sydney and Melbourne in particular, it's been freestanding houses which have boomed. Units less so. There hasn't been that much demand for units, and I think that's because people have been looking for larger properties. And indeed, when I look at the data, I see that 3-bedroom units have been doing better, for example, compared to 2 bedrooms or 1-bedders, right? It's because people want larger space. They want larger space because they've been working from home. Now, the thing is, with the unit market, particularly the inner city unit market, it's been affected by COVID. People have been not wishing to live in the inner city area. And because of the closure of the international border, we haven't had that international migration come through. But that's all now about to change. So as discussed before, we're expecting migration levels to pick up, and that will help the Sydney and Melbourne unit market. So we think rents are likely to rise, and inner city rents for Sydney and Melbourne, as well as Brisbane too. And the prices are likely to do better than freestanding house prices for 2021.
Get this, most suburbs, Cromer, Beacon Hill, Narrowena, Wheeler Heights, Allambie Heights, North Manly, Freshwater, all of these suburbs have gone up about 205 to 215% in 10 years, which means that's doubling twice. You bought it for 500, it went to $1 million, and it went to 2 million and a little bit more just in 10 years. But with units, it's different. Units are sitting at about the 130% capital growth compared to the 200% capital growth with houses. So there's this distance that's opened up between houses starting at 2.2 million and units almost finishing at around that sort of 1.2, 1.3 price range. There's this big gap in between. So my punt over the next 12, 18 and 36 months is what's going to happen is houses will probably sit around that price level where they are because they've done a lot in 10 years. And I think units are going to play catch up big time.
Okay, thanks for listening to those videos. So the story is very simple, exactly what I've just said. Now, just a very quick slide. I kept it there because I've used it a few times in sort of October, November last year, where you could see that the household savings ratio. So this is cash and deposits sitting in the banks. The banks have had a huge growth in the amount of cash that is sitting there from household savings. Okay, this savings has actually happened. All of these savings have actually happened because there was a lockdown and people were not spending money. And that is the other reason is this money is going to go back either into properties, okay, or just retail spending. People are going to buy new cars, new TVs, new extending their house, or doing all of those things. This is a substantial amount of cash that is about to hit our market. Okay. Now, a little bit about rents, very, very quickly, conscious of time. So rents actually are heading up. Okay, there was a fall in all the regions in Sydney, in Australia. There has been a fall, and then now it's ticking up. So Sydney is seeing some rental increases. All the graphs are actually heading up now. Now, this is an interesting one. So on the left there, you see Sydney. Sydney's overall vacancy rate is sitting at 2.6. It peaked at around 4 because of COVID, no migration, students, same story. And now it's coming down to 2.6. It's heading down, okay? If you look at Brisbane on the right side, Brisbane actually sort of through the COVID period here, they peaked at probably somewhere just above 3, didn't get to 4. And then now it is coming down. This period here I'm not talking about, because that period they had a lot of apartments that were built in the CBD of Brisbane, and vacancy rates actually shot up as a result. So that was a bit of a abnormal period, but it's come down to 1.3, and this figure is actually now heading further south. So it's in some parts of Brisbane, you may or may not have heard, but all the way to Southeast Queensland down to Gold Coast, you're getting sub 1%, which is chronic levels. What I'm predicting in the next 6 months, you are going to see this come down to below 1%. Already there is a lot of pressure on rentals. Significant pressure is being built up on the rental side already, okay? So there are stories of 40, 50 people turning up to see mostly houses and townhouses. They are where the rentals have gone through the roof already. And you are going to start to see that in the apartment market. Any of you, if you are renting a place right now and you're thinking of continuing to stay where you are for the next 12 months, then please go to your agent or your landlord and renegotiate the term and the rental right now. In 3 months' time, it's too late. Okay, your rental will, if your lease is coming up for renewal, it's going to go up. It's going to go up much more than you think. It's going to reach chronic levels this year. This year, we're going to have a major rental crisis in our city that nobody is focusing on, nobody is talking about. Okay, that is going to feel. So another very quick one down here, this table is telling you that our vacancies, rental vacancies, again, all over Sydney is different. CBD is 6.9%, Parramatta is 3.6%. It's not 2.6 uniformly everywhere, same as house price increases. Now, we're going to see economic growth. It's a very simple graph for everybody to understand, and hopefully I haven't given you any difficult graphs today. We're going to see jobs growth. We're going to see wages growth as a result of jobs growth. Then you're going to see population growth, which is going to come. Increased rental and buyer demand will follow all of these things, okay? And then you see the increase in property values. It's a very simple graph to understand. This is why I'm calling it the perfect storm. And with interest rates staying low, listen, interest rates, and then we can take Q&A later on, but interest rates are going to go up at some point. It's not going to go down anymore. Next move is up. It's a question of when. If you want my prediction on interest rates, I am saying that interest rates are going to increase in the second half of this year. Sometime after July this year, you will see at least 1 or 2 interest rate increases this year. That's 0.25%, that's 0.5% second half of this year. If you get a 0.5% increase, is it going to have a huge impact on the property prices? No, it won't. It won't, because of all of the other things that are about to hit us. It'll more than offset a 0.5% increase in mortgage rates. So when you're buying a property, what do you look at? It's not just about location. It is, location is number one, absolutely. Location needs to have good infrastructure, roads, metro, hospitals, all of these things need to tick the boxes. So for location, you'll see a lot of real estate professionals will say, you got to tick the 10 boxes. If the 10 boxes are ticked for location, you will never go wrong, okay? You've seen those 10 boxes, I'm sure. If you haven't seen them, I'm happy to share them with you. But they include all these type of things, okay? Then you look at the investments in the local area. Who is going? I'll use Marsden Park as an example, because Marsden Park has had an IKEA go in there. It has had a Bunnings go in there. It has a Costco go in there. Now, these are big organizations. Why are they spending so much money actually building their infrastructure over there? Reason is very simple. They have done so much research on what is coming in the next 5 to 10 years in that area. You can piggyback on their research to go and do your investment. And people living in that Northwest region know very well what property prices have done over the last 12 months. And then population growth. Population growth is not just going to create sort of the demand, okay? And that's why you need supply, but what type of people are actually moving in a suburb is also very, very important. Okay, so all of these things are location. Then you got price. You should never, and I'll say this very, very, very clearly, you should never pay a premium for a property. Never pay a premium. Okay, you need to make sure you pay the right price for the property, if not a wholesale price for a property. That is where we come in. Timing is perfect right now. I'm not going to talk anymore about timing. Timing to buy an apartment off the plan. There cannot be a better time than this in the last 10 years. I can tell you, there could not be a better time than where we are now. Okay. And also becoming very important is who the developer and builder is. Okay. Because we all know, well documented, there are high-rise properties. There's at least half a dozen properties you can't set your foot in because there are structural issues. When we talk about infrastructure, this is the type of things we talk about. We talk about hospital, new hospital coming up in Rouse Hill. The metro has just started. It's going to go you've only seen a quarter of the metro that is going to be developed in this city. Okay. Marsden Park, I've talked about. Riverstone Town Centre, an example. Riverstone Town Centre will be as big as Rouse Hill Town Centre. Not many people know about that because it hasn't started yet. These are the type of things that fuel property, okay? These type of infrastructure projects are very important when you're looking at property considerations. A little bit very quickly in terms of what growth is happening in the Greater Western Sydney, which includes northwest of Sydney. Our GDP in New South Wales alone is bigger than these countries, okay? So, okay, now Northwest Precinct. The northwest of Sydney will be bigger than Canberra in 80 years' time, bigger than Canberra. We all know about Badgerys Creek Airport and what that's going to do to the west of Sydney. The Atropolis, if you don't know about the Atropolis, go and Google the Atropolis. It is going to be a massive, massive development in the west of Sydney. Massive development. It's one metro stop after Badgerys Creek will be the Sydney Atropolis. All big companies like your Googles and your Yahoos and so on, Apple and so on, they already have signed to have their head offices at the Atropolis. Okay. So I won't go through the other two here, but they're all very important. All of this is population growth. All of this is about population growth. I wrote an article firstly, this is the second major article that I wrote, but there's one major one that I wrote in July of 2020 when the whole market was saying 20 to 30% down. That's not this slide, but just for a backdrop. At that point, I had predicted a 20%, July in 2020, I predicted a 20% increase in Sydney's property price in 2021. When the whole market was going minus 20 to 30, I was getting really upset, so I had to write an article at the time. If anybody wants to share that, it is on the Nivas website. You can read it. But in December, I was also pushed to write about the Sydney apartment prices are to surge in 2022-23. And this is the key things here is my key recommendations here, and I've got some recommendations. My key recommendations for you is you got to pick a suburb where there is significant infrastructure spend. That goes without saying. The second point is pick a suburb where there is significant house and apartment price differential. This gap I'm talking about, the bigger the gap, the more you have to gain. And I am actually very strongly suggesting that you focus your search in the lower price range. Example, 550 to 600, but not exceeding, say, 750. That 550 to 750 is where you need to be in the right suburb, pay your 10% deposit, and wait and see your property price grow. Okay, extremely, extremely important also to go with a reputed developer and builder. This is my very strong recommendation. You cannot buy off the plan 2-bedroom apartment in Sydney anywhere now for 550 and under. So your starting point is 550. Okay, whether you're buying in Blacktown or whether you're buying in Penrith or whether you're buying in Schofields or whether you're buying in Liverpool, you will not get anything below 550. Okay, even Mount Druitt, Google Mount Druitt, even their prices are going up. So go for the lower end because you have more to gain. Okay, and it's more affordable. And this is the time to put something away in your portfolio. By just paying 10%, you have the opportunity to leverage, to arbitrage. Very, very important. Now, I will leave you with that, and I'll get Krish to showcase in the next 10 minutes some of our current great value projects. Now, I'll preface that by saying we have at least 25 projects in Sydney at the moment. but we have selected two of what we think is the best value for you to leverage, and they are for good reasons. Okay, I'll leave it with Krish. Thanks, Krish.
That's right. Thank you, Sachin. Good evening, everybody. My name's Chris from the Nivas sales team. Hope everybody's been well. Now, what we're looking at in front of us is Tullawong Village. Now, that dome-shaped building that you see right in the front, that is actually the Tullawong Metro. So this particular project is literally a 50 meters walk to the metro. What you're seeing in front of you, you see that triangular shaped building in the middle, then you've got the other buildings surrounding it. That's stage one. Now, this entire precinct, stage one you see here, as well as the buildings you see in the back as well, this was all owned by Landcom. Now, Landcom are the New South Wales government owner for land. Now, basically, given this whole area forms part of the Northwest Growth Precinct, Landcom then put out a tender to about 20 different builders to basically select the right builder to build this project. So this is all government approved, a government approved project. So they chose Daycorp, who are the third largest builder developer in Australia, to do this project. Stage one is going to be finishing towards the end of next year. You have apartments, then underneath the apartments, you have a retail precinct as well. So you've got 40 specialty shops. You're going to have specialists like pathologists and ear, nose and throat clinics and that sort of thing on level 2 as well. So there's lots of different retail underneath. This is just one of the pictures of the retail precinct. So it's going to be really nice, kind of like a mini version of Rouse Hill Town Centre. Very well spread out. It's not a high rise by any stretch of the imagination. So good privacy, not buildings looking right into each other. So it's a really beautifully done project. Construction has started. And as mentioned, it'll be finishing towards the end of next year. So in terms of the finishes, guys, there isn't really much in the Northwest that compares in terms of finishes. You've got things like engineered timber flooring, 40 millimeter stone bench tops. You've got things like prefabricated bathrooms. And by prefabricated bathrooms, I mean, these bathrooms are built in Melbourne. They're pressure tested, they're stress tested, waterproofing and everything is done there. Then they're brought into Tullawong Village and basically plugged into the apartment. So this caliber of finishes you don't get in the Northwest or the west of Sydney. So very, very well finished product. Very close proximity. So obviously the train store, the metro is right in front of you. You've got retail underneath you. You're a 2-minute drive to the new Rouse Hill Hospital coming up, 2-minute drive to Rouse Hill Town Centre, 25 minutes to Parramatta. So very well connected. All the infrastructure that you need is right there at your fingertips. And guys, I guess the biggest reason why this is actually the fastest selling project in Western Sydney at the moment is simply because of all of this infrastructure, the quality of the developer, and the location. It's an amazing location. So far, to give you an idea, in an 8-week period, 300 apartments approximately have sold in this project. So it's selling very, very fast. There are still some amazing layouts left. Price-wise, 1 bedrooms are from 500,000. 2 bedrooms are now starting at about 685, and 3 bedrooms at about 825. So well finished, lots of good choice. And if you're comparing it, if you're even comparing these prices to Rouse Hill, for instance, like Rouse Hill Town Centre, 2 bedrooms there are going for about 750 to 760 with similar proximity to the metro. You go to Northwest, you're sitting at about 850 to 900 for 2 bedrooms. So for something which is right next to a metro, this definitely is at the lower end of the spectrum when it comes to pricing. And there are some rebates and other incentives there that we do have as well. So very nice apartment building. The next project we're looking at is Q in Schofields. So Q in Schofields is very unique. It's not a whole bunch of apartment complexes upon apartment complexes. This is located on Schofields Farm Road. So basically you're surrounded by houses which are all in excess of $1.5 million. Very, very quiet street. Stage 1 is finished off. We have just launched stage 2. The developer is the builder is the Binar Group. So Binar have been around for about 25 years. They've done lots of projects. They've got more projects coming up. Before we take on any project, we do research on the developer, make sure that they've got no complaints with building association, no complaints with fair trading. We've done strata reports on other buildings that they've done in the past to make sure there aren't consistent issues. So we make sure they're a good builder, and Binar definitely tick all the boxes. One of the most exciting things about Schofields is in the next 8 years, the population is destined to double. So demand all over Schofields is significant. And again, this is just a few projects that Binar have done in the past. So it's a very popular suburb, and people might not be thinking that apartments are in favor in Schofields, but rest assured, they're selling very, very strongly. Now, if we're having a look at the location, you're a 5-minute drive to Schofields train station, 5-minute drive to Schofields town centre, about 4 minutes to Tallawong Metro, and about 9 to 10 minutes to Rouse Hill Metro and town centre as well. So it's well located. And in terms of finishes, as you can see here, very well finished. You've got wooden floorboards, 2.7 metre ceilings, downlights, Miele appliances, ducted air conditioning. So very, very well finished. Stage 1 is a testament to that. We have a display which you can see all the finishes. Bathrooms, again, very nicely done. LED strip lighting, lots of storage, rainwater showers. So very, very nicely finished apartments. And basically what I want to show you here is the future of the metro. So stage 2 of the metro is actually going to be finishing around 2024. So this project, Q in Schofields, finishes towards October this year. And going back to Tallawong Village, that finishes towards the end of next year. So both of these projects are going to be beneficiaries of this stage 2 of the metro, which is finishing around 2024. And what that means is when you go to the metro, you're going to have direct access from Tallawong to Barangaroo. So that's going to be a huge plus point once that all opens up. So if we go on to the next slide, and then of course you'll have connectivity to Badgerys Creek as well and Southwest when the next stage of the metro opens up. So if we go back, so completion for Q in Schofields, you'll be looking at about September, October this year. There are some good rebates. And in terms of pricing, guys, 2-bedroom apartments in Schofields, if you look at other developments such as Bartler and A-Land and a few of the others in the suburb, they're starting from 600 at the moment. The starting for a 2-bedroom is from 600. We are starting from 565 at the moment for our 2 bedrooms, plus the rebates on top. So there's a decent price difference there. And look, it's a very well finished. It's probably one of the best finished products in Schofields. And yeah, great location, great finishes, and exceptionally well priced, exceptionally. And I can say well priced because bank valuations for apartments, you know, in the other projects, which are going for 600 and even up to 615, bank valuations are all stacking up. So bank valuations are stacking up, which are conservative. Then at these prices, it should be absolutely fine. So that's this project in a nutshell. And we also have another couple of projects as well. We have Blacktown, which will be finishing sort of towards the end of next year. 2 bedrooms there starting from 560, 5 minutes walk to the station, and West Point as well. We have Maze Hill as well, starting from 605 for 2-bedroom apartments. And again, compared to other projects in each of these respective suburbs, these are again, you know, very well priced from a good developer as well, the Jasara Group from these two. So we have a wide selection of apartments that you can choose from. We have incentives through Nivas, which are exclusively through us. So please do have a chat with us, and we'd love to help in any way.
Thanks, Krish.
Thanks, Sachin.
Okay, like I said, we do have over 25 projects in the city, but we focus on the ones that generate the biggest value. So there's a price differential between Tallawong Village and the Q project in Schofield is for 2-bedroom apartments, approximately $100,000 difference. Okay. So one is your very, very entry level point in a very, very good suburb where there will be no further apartments built. The other one is giving you the benefit of being right next to the metro, having the lifestyle choice with parks, internal parks, and all the shopping. And level 1, you know, you got your medical center and all of those type of conveniences that creates a lifestyle choice. So 70% of people that are buying in Tallawong Village are actually owner occupiers, which is a very good thing for any investors who are looking as well. So concluding comments from me is I can't be any more passionate about the opportunity that presents us today with respect to buying using my recommendations. You look in the suburb, as I said, where there is substantial price gap. You've got to get into a project that is going to generate you future profits. The reason why I like both these projects is one is almost 9, 12, 10 months away. The other one is almost 2 years away. So Talawang Village is 2 years away. You pay 10% now. In 2 years' time, it has to go up. It's a question of whether it goes up 10, 15, 20, or 25%. That is the only question. Okay. And there is, for lifestyle, people want all of those things. They want that convenience. Today's generation wants that convenience. Now, why should you buy a property? Well, it's very simple. Okay. I have been, and I'll urge all of you actually to as soon as you can afford to buy a property, buy one. If your parents are sitting on, if there's some parents listening and they've got equity in the house, they should invest for their children now. This is a perfect opportunity. You only need 10% to invest now. Okay. Then you can work out over the next 2 years, how are you going to borrow and settle? Okay. But it is a huge opportunity. The reason why Australians are the richest per capita population in the world now, we've gone past Switzerland, is because we invest in property. It's very simple. Okay. The equation is very simple. Property is not an overnight game. It's not like the stock market. You have to have a view that you purchase something and at least hold it for 5 years, at least. But if you can keep holding it for 10, 15, 20 years, you're going to see significant growth. And if you have $1 million in the bank today, okay, if you have $1 million in the bank and your house is paid off and you're living in Sydney, you cannot survive, because $1 million in the bank will give you an interest rate of 1.5% at today's rate, which is $15,000 a year. None of you can survive on $15,000 a year, correct? So you need to do something to generate wealth. And that is where property comes in. So anyone listening to me today, if you don't know how it's done, I am here to actually give you one-on-one expert advice. You can take my details down. I don't charge for it. You don't have to buy a property from me. I just have the passion to actually help people accumulate properties and accumulate wealth through properties. Very simple. Okay. The property market in Sydney, you saw where the population growth is. The property market in Sydney will keep going up and up and up. There will come a time, so we're in 2022 now, so 8 years from now is 2030. In 2030, you can write it down now, there will be no 2-bedroom properties in Sydney for less than $1 million. Zero. None. Okay, that's why right time to purchase is now, but on top of the right time to purchase, you're given an arbitrage opportunity. Influx of people coming here. There is one type of property class that is going to go up more than anything else in the next 12 months. It is apartments. Okay. I was telling people in late 2020 to buy a house and land, or to just purchase land. And those that listened to me are thanking me today. Those that did not listen to me said, I should have listened to you. I'm telling you the same thing now. If you leave it until June, it is too late. You already are too late. You then would be saying, I should have bought back in January or back in December. So I'll leave you with that thought, and we'll take some questions. Sorry, there's some details of our Nivas team. You can take our phone numbers down, or you'll see it on the website as well. You can come through from the website. Sorry for going a bit over time, but hopefully you have found the session today useful and insightful. And I'll take some questions.
Okay, we've got a question here from JT. JT, hi Sachin, thanks for the presentation. Just a couple of questions. Could you provide some further numbers on rentals per week, strata, etc.? Is there a main reason why rebates are being provided? There are lots of 2-bedroom units with the move to work remotely, say 10% of population. Would the trend go towards 3-bedroom units instead? So the first 2 questions I can answer for you, JT. So with regard to the Daycorp project, Talawang Village, that particular project, the strata for a 2-bedroom you'd be looking at, you'd basically be looking at approximately $850 to $1,000 for the strata for a 2-bedroom there, a quarter. Your rentals at the moment over there, as far as I'm aware, you'd be looking at about, I would be saying about the 570 to 580 around that price a week, if I'm not wrong, for a 2-bedroom apartment. And with regard to council and water, you'd be looking at a combined roughly 400 a quarter for council and water. That's for Tallawong Village. For Q, 2 bedrooms, you'd be looking at anywhere from 750 to 900 for your strata for a 2-bedroom. Your water and rates would be around the same, 400 a quarter. Rentals in Schofield, you'd probably be sitting at about, I would say 500, roughly 490 to 500 for a 2-bedroom. And in terms of why the rebates are being used, so basically these discounts, so whenever we get a project, we're given a certain sort of parameter as to how much we can sort of discount off the price. So what we do is these rebates aren't actually a cashback, it's a discount that you'd be receiving off the price. We give that up front. We give out whatever the maximum incentive is from the developer. We don't keep it up our sleeve and sort of use it as a negotiation tactic. We just give that up front, and basically hence the reason why those rebates are used. Now, I'll leave it touching. Yeah,
I'll take the other points. JT, thanks for the question. Yeah, you raise a very important point. So there are lots of 2-bedroom units, and with the move to remote work, would the trend go towards 3-bedroom units instead? Your question is absolutely valid, and the answer is absolutely yes. Okay, so see, in terms of size of accommodation, so of course, house is number one. Then if you can't afford a house, you go to a townhouse or duplex. If you can't afford those, you go to a 3-bedroom apartment. If you can't afford that, you go to a 2-bedroom apartment. That is the sort of the reality of life. Okay, so in the old days, when I say old days, in the last 20 years, most of the apartment buildings that went up in Sydney, the majority of them were 2 bedrooms, like 70%. Then 15% would be 3-bedroom and 15% would be 1-bedroom. That was where the demand historically came from. That demand is going to change now. There's going to be a paradigm shift in the demand where there will be more 3 bedrooms needed or 2-bedroom plus study needed. Okay. And there will be, I think the owner of Meriton, Chokabov, has already said that he will be looking at his future projects whereby the mix will have to change, and he's going to put more 3-bedroom and even some 4-bedroom apartments going forward. So this trend is going to change. There will be a lot more demand for 3-bedroom apartments. It just comes down to affordability. If I were to say to any of you listening today, if I can afford a 3-bedroom apartment, should I buy a 3 versus a 2? Absolutely. Answer is yes. But make sure you buy it at the right price. Okay. They will go up. There will be huge demand for 3-bedroom units. So good question, and hopefully I've answered it.
Thanks, Sachin.
We've got another question from Chetan.
Yep, go for it.
Interested to know what your views are in investing in a house in Brisbane compared to investing in apartments in Sydney. It's a good question, and listen, we get that a lot, and we also sell in the southeast of Queensland. We get that question a lot. Brisbane has had a very strong run, as you all have seen. Will Brisbane prices keep going up like Sydney this year? Absolutely, they will. Okay, so I've given you a lot about Sydney today. The reason why Brisbane prices are going to go up, you saw those rent vacancies actually come down to 1.3, and it's going to go down below 1. Chronic levels of vacancy for rentals. And you have only seen the reason why those rentals went down is because they saw internal migration from Victoria, mostly Victoria, and partly from New South Wales. However, they will continue to see a lot of internal migration. Victoria will be probably the biggest loser of people to Southeast Queensland for a number of different reasons. I won't go through it, mostly COVID related, right? And Premier related. However, there is a lot of interest from New Zealand, places like New Zealand, places like South Africa, where they see a lot of people actually move into that part of the world, the Southeast Queensland part of the world, because of the climate, because of the lifestyle, and because of everything else. So yes, Brisbane will go through the Olympics. Don't mention Olympics at the moment, because it's not going to happen this quickly. Okay, Olympics is way out there, but the prices only increase in places where there are the bigger venues. So we saw that in Sydney, in Concord, and we saw that near Olympic Park, surrounding suburbs around there, North Strathfield and so on, where prices actually double for the 2000 Olympics. But the point is, Brisbane and Southeast Queensland will go up. Is it a better buy than apartments in Sydney? I would say probably not. Okay, it has had a strong run already. We were selling houses. We're selling house and land packages in Brisbane, which have gone up by 125,000 in the last 12 months. So it is getting to that sort of high stage. You need to be a bit more selective in terms of where you buy, and you will definitely see growth there. So most banks are actually also predicting that the Southeast Queensland market is going to be quite strong in 2022. So listen, I cannot give you a straight answer other than to say both markets are going to see an increase. Any other questions? Conscious of time as well.
Sachin, thank you so much. What a very good start of the year. Just a very quick one. As we know, my team sold a lot in Schofields, and some of them would like to invest again. Can you check what is the current or vacancy rate at this point in Schofields area?
Absolutely, we'll get back to you. You can actually get that through SQM research.
About
Chris, you have an answer?
About 1.5%.
At this point, yeah.
Yep.
Cool.
Yep.
So listen, that's a good point that Nanette raises, and I should actually elaborate on that. There is negative media. There has been negative media on the suburb of Schofield and the surrounding northwest suburbs, where there's going to be a lot of apartment developments coming up over the next 2-3 years. And what these media articles have not talked about, they've talked about the supply, but they haven't talked about the demand. So you've seen the demand story from me today. Okay, the demand story is councils will only approve certain number of apartments and in a timely fashion to accommodate the influx of people that are coming. The demand will outstrip supply. You can write it down. The demand will outstrip supply significantly in all these suburbs. The reason why we are getting all these apartments developed there is because that's where the population growth is actually coming. If some of you who are living in Ponds and Schofields and Marsden Park and those areas at the moment would already know what you have seen in the last 5 years. Well, next 5 years is going to be more shaping of those suburbs. You will work there, you will live there, you will go shopping there, your children will go to school there, they will grow up there. Okay, this is a paradigm shift. What we are going to see is, like I said, 1 in a 50-year transformational change that is coming. So if people are going to want to write one-sided articles and say, oh, the biggest supply in Sydney is coming in these suburbs, of course it is coming there, but so is the demand. Okay, and so the demand will continue. We were selling house and land packages in Schofield a year and a half ago and a year ago for $650, $660. You try buying something there, house and land, under $1 million today. Okay, there's a huge gap there between apartment and house prices. Huge gap. I'll leave it at that.
Sachin, Jose, Jojo here. Thanks for your presentation. How's everyone? Chris, how are you? Just on the infrastructure projects for New South Wales, especially the rail or the train going to the airport, do you know when are they going to start that, and how is that going to go through Marsden Park to St. Mary's?
Listen, the current proposal is that it goes to Marsden Park and then goes to St. Mary's and then goes to Badgerys Creek. We are not that clear on where the station actually will be for Schofields. We still haven't seen anything clear come out on that. But listen, it's the government will want these heavily populated growth areas to be well connected to the airport. So in terms of timing, I think that project won't start until about probably, well, it has to coincide with the opening of the Wedgewood Creek Airport, I would suggest. So we're still 3-4 years away.
Mhm.
Yeah, sorry, just to jump on that, Jojo, I can answer the timing wise for the metro. It's Raj, by the way. So from Talawong, what Chris was mentioning about the Talawong project, that station there at the moment goes to Chatswood in about 32 minutes, that train. So that is going to get extended all the way to the city. That is phase 2 of the metro. Phase 3 will be where St. Mary is going to get. So Talawong will be extended to St. Mary's, going through Marsden Park. And then from St. Mary's, that's going to be stage 3, which is going to commence, I would probably say, end of 23, 24, and it'll finish before the airport actually opens. So all of these projects, they will complete before the airport actually operates, which is end of 2026. Sorry.
It would be exciting. Yeah. Thank you. Thanks, Raj.
Yeah. No worries.
Okay, well, I'll take one more question if there is one.